MRR, or monthly recurring revenue, is quite literally the amount of revenue that you recognize in a given month. Online, it defines it as the predictable total revenue generated by your business from all active subscriptions in a particular month. So if we break this down just a little bit, it's saying that it's revenue from your active subscriptions, or it could be a contract, it could be a fixed contract as well, but it's the amount of service that you recognize in a given month, as well as it has to be predictable. So it has to be something that you know is going to be coming next month, or you've got a fixed contract with a term, every single month you're providing a service and there's going to be a certain amount of revenue tied to that. Or it might be a subscription-based business where somebody signs up with their credit card and they are exchanging, a monetary amount every single month. They're going to charge every single month for access to their license, like Netflix or, like Office 365. So it's got to be predictable. You know that next month you can have X amount of revenue based on your MRR. It does not include, or is not, one-time project fees or any sort of a one-time fee. If you were to sell something, like you're selling a product or a good and it's a one-time sale, that does not count as MRR. Even if you know to some degree some sort of an expectation as to what you're going to be selling next month, that still does not count as MRR, because you're essentially generating new business every single time you get a new sale. Whereas an MRR based business, it's a subscription that's on an ongoing and going sort of business model. I'm going to quickly walk you through two different examples of some MRR type businesses. So example number one is a monthly subscription based business, just like ones like Netflix, Microsoft Office 365, or Adobe. You're basically signing up on a monthly subscription where customers are entering their credit cards online and they're granted access to a license to use some software or whatever it is. Revenue is recognized upfront at the time of signing up. Right? Because you enter your credit card. As soon as you enter that credit card, you hit enter, the customer now has access to that piece of license or that software. They can start using it right away. So you are effectively, executing on your side of the business by granting the license to the customer as soon as they pay. And then the other key part here is that the subscription lasts forever unless it's canceled by the customer. And for this particular example, we're going to say that it's going to cost $12 a month. So maybe you're signing up for Netflix. You're now getting access to all the videos and all the movies all the content that's on Netflix in exchange for $12. Netflix is granting you access for a month based on the $12 that you gave Netflix. So let's just take an example here. Somebody signs up on January 1st and pays the company $12 to sign up for the service. So you can see in that month, we've literally got $12 worth of MRR, $12 worth of monthly recurring revenue in that given month. What happens from an accounting standpoint is the company is going to receive cash on signup. So they're going to receive $12 cash in the bank, and then they're going to recognize $12 worth of revenue. Okay, and that's it. So that's the first month. 1 month down, you got $12 worth of MRR. Month two comes along, and the customers still signed up on a subscription-based model. Their card gets automatically charged, and now they've got access to the next month. So they got $12 over here. So same thing, you go over to your cash, and on the company, you charge $12 in cash, you get another $12. You got $24 so far from this one customer, and you credit your MRR revenue. Okay, now let's just take this one more step further. Let's just say you get another month, but in this month in March, we get another customer. So another customer now comes along and also signs up. So now you're going to have two customers in tandem that are going to be paying and using your subscription. So now all of a sudden your MRR from 1 month before where it's $12 a month, now you're up to $24 a month. You now have a predictable base of revenue of $24 per month, assuming that these two customers are going to be renewing month to month. So now it's the same thing. We're going to go into here, and instead of $12 being credited, we're going to debit into the account. We're going to debit in $24 cash collected for the two customers that now paid for the month of March, as well as now $24 worth of revenue. And now we basically just carry this forward every single month, April, May, June, right? And you keep going all the way to the end of the year. These two customers stayed on board the whole time. The first customer granted us $144 worth of revenue and cash throughout the year, whereas the second customer granted us $120. But you can see here the MRR, the monthly recurring revenue, was $12 in January, $12 in Feb. Now all of a sudden you're up to $24, and it's $24 indefinitely until somebody cancels. So that's basically the first example that I want to show you of what MRR looks like in a monthly subscription-based business. Flipping over to example number two. In this example, we're going to go through what it might look like if you had an upfront annual contract. So this would be for certain industries where you're providing a contract service or you're doing an annual upfront subscription. So just like in the last ones, instead of paying month to month, maybe you're going to charge the customer for 12 months in advance at a discount. Okay, so that would also apply into this second example scenario. So some example pieces here. Customers sign up for 12-month subscription and pay in advance. Okay, so that's what we're going to say here. Revenue begins to recognize at the start of the service, spread over the contract term. Okay, the subscription lasts only until the end of the contract, so it doesn't necessarily last forever, although they might renew at the end of the contract. But in this time, they've paid for 12 months, and we know for sure that there's going to be 12 months worth of revenue. And in this example, we're going to say it's $144 for the contract year. So there's no discount. It's just somebody's going to pay for it in advance. They're going to give us $144 worth of cash up front. They now get access to the license for 12 months. And us as a company, we're going to recognize that over a 12-month period. So I'm going to show you what that looks like. So in the first month here, let's just say the example, somebody signs up in January and they're going to pay the company $144 cash because they now signed up for a 12-month contract to have access to our Netflix subscription, as an example. At the same time as us collecting the cash, debiting cash, the company is also going to now credit $144 in deferred revenue. This is because we've collected the cash up front, but we haven't executed on the service because it's happening over a period of time. So for this, we're only going to be able to be allowed to recognize 1/12 or 1 month at a time as we sort of execute on that service for the customer. So this is the part one. We collect the cash, $144 cash for $144 of now owed. It's a liability. We owe that now to the customer, 12 months worth of service. Now the part two to this is in the first month, we're at the end of the month here, we're going to be recognizing $12, right? Because this is 144 divided by 12. You can just see with the calculator here. We're going to go 144 divided by 12. So 1 month is $12 worth of revenue. So we're going to recognize $12 in the first month. And then while this happens, $12 worth of revenue, we're going to credit here, but we're actually going to take this out of our deferred revenue. So now we owe the customer $12 less worth of executable service. So now we only owe the customer $132 worth of deferred revenue for the rest of the contract. So you can see here the balance of the deferred revenue now goes down to $132 after the first month. So our MRR is $12 and we've got $132 left in deferred revenue as we go through this contract. So now we go into month two. The customer's still already paid in January. They've already prepaid. We go into month two. They recognize another $12. They've used the service for another month. We recognize $12 in that month. And same thing, we're going to go over here and we're going to debit out $12 from deferred revenue. And as we recognize the $12 of revenue here. So we're taking it out of deferred and moving into recognized revenue. You can see here the ending balance is $120 left in deferred revenue, 120. And now this basically happens for the whole period of the contract. So this MRR, monthly revenue recurring stream, is going to happen all the way to the end of the year. We're now going to execute on the entire contract. So that's the first 12 months done. They paid $144. We've now recognized $144 by the end of the contract. And you can see here that the deferred revenue is going to go down every single month. We're going to owe that customer less and less and less as time goes on until we get to the end where we fully recognize that revenue at 144. We now owe the customer nothing. So now it's a clean slate. We walk away from it, $144. Now the hope here is that the customer is going to renew for another 12 months. That's the idea, is that you're trying to get that customer to renew. You don't want them to churn and to leave out. But that's basically how you recognize this particular instance of an annual upfront contract.